In this video, guys, we're going to look at trading and opinions, a dangerous combination. Stay tuned. Hey guys, warm welcome to you. Alright, so in this video I want to talk about trading and opinions, super dangerous combinations, the difference between your opinion on the market and a thesis that you're going to prove right or wrong and trade around. The difference being this: an opinion is something you believe is going to happen, and it's just an opinion, like, I believe England are going to win this football match. I believe that Russia are going to become the next biggest economy. I believe, a bad example, you get the point. You're just a belief based on whatever it may be. Maybe there's some facts behind it, maybe there's not, but whatever it may be. Okay, so the difference between that and a hypothesis is, let's use that example of a football match. I believe that England are going to win the football match. I think so. We're going to see how they play. If they start playing well during the first 15 minutes, 30 minutes, first half, then your hypothesis may well be correct. And perhaps if we're talking about from a betting perspective, you might then start to bet on England winning that football match. If they start and they're poor and they're playing awfully and the ball's all over the place, they're losing possession, they're not getting shots on goal, this kind of stuff, it's starting to prove your hypothesis wrong. Same with the market. You have a hypothesis, I think the market's going to go up and hit this level today. If it starts holding levels, key levels, doing higher highs, higher lows, and not doing too much work to the downside, maybe your hypothesis is correct. But anyway, back to the point. The point here is that if you have a bias, you're okay. And if you're kind of looking at stuff and you're seeing if it's correct with your thesis, you're okay. If you've got an opinion, you're dangerous. And Jesse Livermore said two of these things. He basically said, listen, the stock don't buy a stock just because it's down a lot. In other words, this is number one: the market's reversed a lot, I'll buy it. And I see this quite often with particularly newer traders who haven't been through markets that have done extreme moves on them. They think, well, it's down a lot, then therefore it's going to bounce back, so I should buy. No, that's never going to be the case. It's down a lot and then nothing will stop it going down lower. And as Jesse Livermore says, don't buy a stock because it's reversed a lot from the highs. And this is probably from a swing trading perspective, same from a day trading perspective, just because it's that. Now, that might be part of a filter that you use to look for a further buy entry. It's come off the lot, but that can't be a sole reason. You know, an opinion that it's down a lot is not a reason to buy it, because the thing could go down to zero effectively. The same when the stock is way overpriced, I'll sell. That could be any market, by the way. The stock is way overpriced, I'll sell. Specifically for stocks, slightly different for currencies because it's a pair against the two. The stock is way overpriced, I'll sell, and end up taking profits too soon because you think, well, I've been in this now and it's come a long way and it's very, very high and it seems a bit way overvalued. I'm going to take my profits. But it's not, again, it's your opinion on valuation. You've got to remember the reason it's still up there is because people are still considering it as value, and you're on the minority by considering it as overvalued at that moment in time. Sure, things can change, but we've seen stocks go from kind of $20 to $200 at IPO all the way up 2 or 3 years later, and they're still chugging at the time of this video. So, you know, there's no rhyme or reason sometimes this, and that's why it comes down to trading patterns and price actions. Why my price action is my thing and why I like it, because it kind of proves or disproves, and you're looking for evidence of the trade as opposed to making a guess on the trade or making an opinion on the trade. You're having an idea, a theme, and then seeing if the price action confirms or negates that. All right, number three, guys, the news is bullish. I'm a buyer. Big mistake people make, and actually I quite like people making this mistake because as traders we capitalize on this, can't we? When people are buying let's say a smaller cap stock because the news looks good and it starts to go up and they're buying and it starts to reverse and it goes negative and they're scratching their heads thinking, what's going on? That's great, because price action is telling us it doesn't matter that this is bullish news. Price action is showing that everyone is dumping into this news and you should be shorting it too or selling your holding, and that's a big one. That number four, the move is too fast. I'm fading it. Many new traders see this as well, and listen, there is a time and a place for using speed and pace of move to scale out into, but just having an opinion on this, saying, well, that's too fast of a move. Well, what happens if it's really fast and then stagnates at highs for the next few days or the next 15 minutes or whatever time for your trade, and then goes another leg? That's still no use to you because it's still unwound, but on a time perspective, very often the markets will move very aggressively. Now, will they continue in that direction for the rest of the day? Unlikely. sometimes happens. Sometimes you get these monster drives. But what about if it just sits there and just goes in real stagnation mode? That's no good if you're going to go short, and that's no good again if it kind of continues and then drives again later in the afternoon if you're long and you've closed your position. So the move is too fast, especially if you're fading it, is a deadly thing. And again, it's an opinion. It could be moving fast because liquidity is low. It could be moving fast because there's so many reasons that it doesn't make any sense just to look at it from that perspective. All right, fifth one, guys, there's no reason for this to be here. I'm long or I'm short. And this is a kind of catch-all that I see a lot of traders doing. And listen, I've made this mistake myself before when I was starting out. Hey, why is this the market up here? It shouldn't be even. Remember thinking back now when Dow was kind of approaching, I think it was 10,000 and whenever that was. This shouldn't be approaching 10,000. This is way too overpriced. Come there too quickly. It's got to be a short. It's got to be short. It's selling this, and no real reason at all. You're in a bull market. Everything's bullish about it. Just your opinion that it's too high is irrelevant. Look at where we are now. If you carry on selling the short of the Dow at 10,000, you'd completely be wiped out. But the point is, guys, the whole thing is opinions are useless in the market. And Jesse Livermore says exactly the same thing. Never sell a stock because you believe it's gone too high. Never buy a market because it's reversed a lot. In other words, never put your opinion on the market. Always look at what the market's telling you. Yes, I know easier said than done. It's never going to be like, oh, buy me now, because if you buy me now, you can sell me again tomorrow at a higher price. It doesn't work like that. But what you can do is you can look at stuff objectively and have various benchmarks and guides and checks that you do to say, well, actually, yeah, that's pretty bullish. Yeah, that's pretty bullish. That's pretty bullish. And ignore absolute moves. Like, okay, well, it's up 100% the last few days. It shouldn't be, well, you got 500%. It doesn't matter. It's what's the underlying move like? What's the structure of it? How is it held there? All these kind of things. So careful of your opinions, guys, especially if you're coming into a trade. Opinions are okay to seed an idea from. I'm saying that carefully. They're okay to go, right, well, I only want to look at yen because I think yen's done this, it's come quite a way, and then looking and adding proof to it. Obviously, you've got to be objective with this, otherwise you're just reinforcing what's already a bad decision. You've got to be objective and kind of have the bull argument and the bear argument. But then you look at it objectively and you go, right, okay, and then you make a decision from there rather than forcing your opinion on the market. So be careful of that, guys. I've been caught out by it, and I bet you may have as well. As many of you watching this have probably been caught out on it too. So watch out for your opinions in trading. It's a dangerous combination when you add them together. See you in the next one. Take care. Bye-bye.